Divergence to a trader is when the price of a stock is moving in the opposite direction of an indicator. In this case here, I'm referring to the TICK and the ADD in relation to the S&P 500. This is a good example on the chart here, as it's relatively very easy to see. Yesterday, after about 10:15 a.m. Eastern Time, the S&P 500 started this intraday downtrend, as we can see right here. In contrast to that, the ADD, which is the advancing declining NYSE, New York Stock Exchange indicator, was showing that the majority of the stocks in the NYSE were advancing versus declining. And in addition to that, the tick was showing on a 1-minute time frame that more stocks were also ticking up. That is a reduced way of thinking of these two indicators in relation to the S&P 500. Let's look at it on a larger scale here, and let's think about how we can use this as a trader. This right here is relatively easy to see, as this was the day before price action. We can see that there was a strong sentiment or a little bit more of aggressive buyers in this area, as once price dipped into this range, which was around 615 and a quarter, 615 and 40 cents or so on the S&P 500. In this area here, we can see how aggressive buyers stepped up. Volume spiked right here as soon as the market dipped into this area. Then it tried to come back down into this range here. Buyers were aggressive again. Price bounced. It came back down into this area and buyers are aggressive, ultimately leading into this 30-minute rally into the close. To a trader that uses supply and demand, can think of this as this whole zone here, as we can see earlier in the day, was support. We can draw a zone around this whole area here, and we can label this as a demand zone. We can say that there is potentially support in this area, all these different things that we know as traders that use technical analysis. So this zone becomes a potential demand zone if price was to enter into it again. Yesterday now, after 10:15 a.m. Eastern Time, the market declines into this area. So as price is in this zone, it is in this demand zone, it is at this area of support, a trader can tell themselves, hey, I may want to take a long trade here, potentially with a stop loss below this zone. But what are the reasons for me to get long? Ultimately, as a trader, you want some sort of confluence with your idea for your trade. So if you want to be long, what are the reasons to be long? One reason is price is potentially at support, as we can see it has held up at this area before. A second reason could be it is a demand zone, because we can see the aggressive buyers here yesterday, and we can see price rallied into the close, breaking the high of day off of this rally from this demand zone. So we have demand, we have a previous support level, and price is here again. Now, what extra reasons can we find? If we take a look at the ADD, it was in a aggressive rally all day. This is 10:30 a.m. Eastern Time. This is 11 a.m. Eastern Time. From the moment the market opened, more stocks were advancing relative to them declining. So think of it this way. While this is the NYSE and the S&P 500 is the top 500 stocks, the NYSE contains different baskets, but there is a lot of overlapping stocks in both baskets. There is an advanced declining indicator for specifically the S&P 500. It's just that the ADD is more popular, so that's the one I'm addressing in this video. So let's just say this was a perfect representation of all the stocks in the S&P 500. If majority of all the stocks in the S&P 500 are going up, then why is the SPY going down? That is divergence, and it makes no sense. It is a reason to think that the market will probably bounce if majority of the stocks are strong at that current moment. On top of that, the tick was showing a healthy uptrend all morning. This is around 10 a.m. right here. This is around 10:15 Eastern Time here, all the way up until noon right here. So 12 p.m. Eastern Time, it was in a healthy uptrend. So we have an uptrend here. Price is moving like this, and an uptrend, higher highs, higher lows. We have a very clear uptrend right here, higher highs, higher lows. But then we have this uptrend in the morning on price that is broken as weakness enters the market into this demand zone. A trader can interpret this selling as a bluff, saying they don't believe there is enough strength or momentum behind this selling to break below this demand zone. And the aggressive buyers down here are willing to buy at the asking price or above the asking price, which will result in the price bouncing. The other indicator that I mentioned earlier is the ADSPD. This is for the S&P 500. We can see it right here, a clear uptrend all morning. So whether you use the ADD or the ADSPD, they were both showing the same thing. As a trader, you want to look for reasons at key areas on your chart. In this case, it is the demand zone, it is the support level that is the first indication that you may want to get long. You should be able to see it on your chart first. This is reading price action. This is understanding supply and demand. And then you're looking at indicators like the ADD or the TICK for additional reasons to get long. The reason to get long should not be because you see the ADD going up first. That is not a strong enough reason. The same thing, because you see the TICK going up, that is not the reason you want to be long. You want to be focused on the price action first, and where is price in relation to key areas on the charts. Guys, if you enjoyed this, like the video, leave a comment down below, subscribe to this YouTube channel. I've mentioned this divergence on this YouTube channel before, but I just wanted to come on and do a dedicated video to it. Thanks for watching, guys. I'll catch you in the next one.